Hey gang, it's November the 14th today? Yeah, it's November the 14th. It's Thursday. The market's going to close in less than an hour, and as I promised, I'm going to give you my afternoon update. So, bad news, jobless numbers. The expectations were between 214,000 and 215,000. Now, I got to say that's remarkably strange because that's a very narrow range. Usually the range is between 205,000 and 215,000. A 1,000 range is just really tight, but nonetheless, it doesn't really matter because the number came out way out of line. The number came out at 125,000, which is an increase in jobless claims, a higher increase than expected. As you could see here, we went above the upper end of the range. Still nothing to really get too wound up about because this number could be revised, but something to take into consideration. As a result, utilities, defensive stocks, higher. 2 days in a row already. Volatility, let me show you volatility. Now, volatility, I told you a few years ago that it's a good time to buy volatility because it's at a 2-year low, and I expect it to begin rising. And it went down to about the 12 level. Now it's hitting the 14, 15 level. Now, I believe we're going to see a spike in volatility because I believe that the SPY is going to cool off. Let me show you this. I believe it's going to cool off and it's going to hit the 200-day moving average, which would put us right at about here, right around the 300 level. I believe we will see the 300 level on the SPY and the bond market, which is also rising today. This is a leveraged bond market, but it is the bond market. This equals the 30 and the 10-year bond, which move neck to neck with each other. But as you can see here, when we go to a shorter time period, you will see that bonds have been rising for 3 days already, and I'm expecting a little bit more upside. Now, one thing that's bothering me is the fact, aside from jobless claims, is the fact that the S&P has been now overbought for 2 weeks, close to 2 weeks. And it hasn't really gone up. I mean, you could say this is going up, but I mean, we were here around 308, 309, 307, and we're still here pretty much at the same level. But while that's been going on, and if you follow me daily, then you know what I'm about to talk about. But if not, look at something interesting. These are momentum levels. Momentum levels tells us what percentage of stocks move up. We were at 77 percentile. We had 77%, 76 point something percent of stocks trading above the 200-day moving average. As you will see here, right there. And notice that's been the highest we've gone to in the last 4 months. And every time we've gone up to about the 75th, 76th level, we've come off. So in the last week, on the 7th, we were at the 75th level. I thought 76, but 75th level. And now we're approaching the 70th level. And stocks are still moving slightly sideways to slightly higher, if you will, or maintaining strength. And that's worrisome because you have less stocks causing upside momentum, but stocks are still rising. That's narrowing of momentum. And if you look at small caps, which are really more sensitive to this market, you will see that they've been coming off during that entire time that momentum peaked. And over time, if the small caps keep coming down and if momentum levels keeps declining or decreasing or narrowing, whichever way you want to call it, as we believe it will here, you're going to see the S&P, whether it likes it or not, start cooling off and that rubber band start snapping back to the 200-day line, which will put us, as I said earlier, right around the 300 level. So don't expect the market to go up from here. We already had 3 gaps in the last month. That's intense. So Here's where we stand. Tomorrow we have a lot of reports. My opinion, to focus on the real big ones is going to be the retail sales and industrial production. Retail sales and industrial production drive the economy, give the economy about 93, 94%. Retail sale alone is about 75% of the GDP. So let's look at the expectations. Consensus right in the middle of the range, growth of about 0.2%, mostly flat. Year over year, we're down about 1.5%, 2%. Not great, but not terrible either. So as long as we come out positive, 0 to 0.3, we'll be okay. But again, you got to keep in mind, retail sales is what drives the economy and also what gives us that end of year rally. And if we're not going to get a really good retail sales numbers, we're not going to see that Santa Claus rally. And that really gives the market that first quarter tone, that setting, that framing. And I'd like to see that. So keep your eye on that tomorrow. And also keep your eye out on the small caps. If the small caps continue moving lower, while the S&P 500 just sits there and just goes sideways, it's only going to be a matter of time till you'll see the S&P catch up on the price action and also begin declining back down to this level right here. And I'm almost certain that you'll see a decline to the 300 level over the next few weeks because of the stretched out effect we're seeing on the RSI. If you look here, notice we were stretched out and then boom, we declined, went overbought. Oversold, stretched out, overbought here, went a little further, trickled, and then boom, went down to oversold level, and then again, overbought over here little by little, and went back down here. The RSI, it's really overbought right now, and I think that has a lot to do with the fact that the Fed lowered rates 3 times this year, and the fact that Trump and China are really trying to work things out, and the market is doing everything possible to price that in. The problem with that is these negotiations can go south very, very quickly. Right now we have barely a bandage on. So the market is being driven by a huge amount of hope right now. And hope and fear are not good when it comes to the market. So again, I believe we're going to have a soft landing, a pullback. Volatility will rise. Small caps will go a little bit lower. And hopefully retail sales data will be on par. But right now, it's time to get defensive. You want to look at gold, ticker symbol GLD if you trade ETFs. ETFs are great because you could trade them with any stockbroker. So you got gold that's been moving higher last few days. And you got the bond market. Notice they're almost mirroring each other very, very tightly right here. And that's because the market is getting ready for some defensive action. All right, hope that helps. Folks, I got to be straight with you here. I'm not the only one questioning this rally. Wall Street and large institutional traders, aka smart money, they haven't been buying into this rally either. You can tell by the amount of volume in the market. We just had a big move to the upside, hit record highs, yet volume, it's been weak, it's bearish. Also, we have what's called narrowing of momentum. And that's when you have less stocks driving price higher. That usually happens right before a move down. And that's why you need a diverse set of positions in your portfolio that don't move lockstep with the overall market. Just trading stocks won't cut it going forward. And that's why I build a system that's specifically designed to thrive no matter what the broad market does. Less correlation, more diversification. It's especially designed to trade assets that are not, I repeat, correlated with the market. I guarantee you've never seen a system like this. Follow the link below to get all the details now. Don't procrastinate. This market is going to move south, and I want you to make money during that time.